Okay, good afternoon. We'll call the meeting to order. This is, of course, the monthly meeting of the Public Pension Oversight Board. In case you had the wrong room, but that's what we're talking about today. We're talking about pensions. Madam Clerk, would you please call the roll?
Senator Byrd, Senator Carroll, Senator McDaniel,
Here.
Senator Mills,
Here.
Senator Neal, Senator Nemus,
Present.
Senator Wilson, Representative Bojanowski, Representative Fleming, Representative Graham,
Here.
Representative Petrie,
Here.
Representative Pratt,
Here.
Representative Tipton,
Here.
Representative Weber,
Here.
Mike Harmon, John Hicks, Victor Maddox, Sharon Mattingly, Representative Hale,
Here.
Senator Higdon,
Here.
Representative Johnson. We have quorum.
Okay, thank you. We do have a quorum. Entertain a motion for the approval of the minutes from our last meeting. We have a motion and second. All in favor signify by saying aye. Aye. Opposed? No. Motion carries. All right, today we get to hear a lot about actuarial validation and valuation, updates. First up would be Bo Craycraft. Bo, the floor is yours, and introduce yourself for the record, and please proceed.
Awesome. Good afternoon. For the record, my name is Bo Craycraft. I'm the Executive Director of the Judicial Form Retirement System. It's good to be here today and have the opportunity to speak. I've been asked this morning to provide a quick update on the most recent actuarial evaluations that were performed for both judicial retirement and the legislator's retirement plan. So I have just a few slides, and to keep us moving quickly, I'll start with slide 2, which is just a high-level quick snapshot of both plans and results from the July 1, 2023 evaluations. Most notably, what you'll see there kind of in the middle of the page is funding level, which is the ratio between total liability and actuarial assets. All 4 plans, both on the pension and insurance side, have now reached full funding, which is new for 2023. You can see, though, with regards to contributions, there's still a slight contribution on judicial retirement. I'd hope that would be 0, but just the way that the amortization process works, much like the plans that you're going to hear a little bit later that have an unfunded liability, they're amortizing that over a period of time. With regards to a surplus, the process is the same. Whether it's a gain or a loss, it's being amortized over time. The goal there is to kind of smooth the employer contribution so you don't have significant jumps up or down. And so there's a slight pension request of just under $700,000 for the current budget process, and that was included in the budget request that we made. I've also just included a quick snapshot of membership. Really, the goal there is just to show you that the cash balance plans are growing, but clearly the legacy tier of benefits is still driving membership. And as we look at some of the underlying liability, you're going to see that it's still significantly and overwhelmingly driving the liability for the plan. Slides 3 and slides 4 are just a little deeper dive into JRP and LRP. We'll start with JRP. Just real quick, I don't want to spend a ton of time on this slide, but just 3 key points. First, you'll just see that the funding level improved slightly on the pension side. Actually saw a little deterioration on the retiree health side. It's a little, it really didn't deteriorate much. The surplus assets actually went up, and as well as the actuarial assets, but the liability grew just slightly faster than the assets. And so you see a decline. Given the size of our plan, a little change can have a fairly dramatic percentage change. Secondly, I always like to look at actuarial value of assets versus market value of assets. So there in the middle of the column, you can see with regards to both of the plans, the actuarial value of assets is less than the market value. Again, we had a very successful 2023 fiscal year. The current fiscal year hasn't got quite off to this good a start, but generally speaking, when you see an actuarial value of assets less than the market value, that's kind of a hint that you still have some gains that are remaining to be recognized in the future. So hopefully we can continue to get a little positive gain there. And then lastly, as I just mentioned, with regards to the accrued liability, you can see both on pension and retiree health, the legacy plan is still driving that liability, 99% or more. So while the membership is starting to change slowly but surely, and JRP is a little slower given the term lengths of our judges, you're going to see both with JRP and LRP that the legacy tier of benefits is still driving the liability. The next slide is just a quick 5-year trend for the judicial retirement plan. And just kind of a couple key points with regards to unfunded liability, recommended employer contribution. You can see that the trend has been that on both sides the plans have improved. Funding levels have continued to slowly grow. The other thing I'll note here is we only do funding values every other year, so this is kind of a mixed match of GASB and funding values. But I think for the purpose of seeing a trend, it still communicates the overall picture. Retiree health, as I mentioned, you saw a slight deterioration in the funding ratios, but you can see the surplus assets are still pretty consistent with the current fiscal year. The next two slides are similar for LRP. Really, the comments are going to remain the same. The one thing I'll note with regards to the trend is, as we did include the recommended employer contributions that were reflected in the valuations and requested as part of the budget. But as many of you all know, LRP has not received any employer contributions since 2019. So that doesn't reflect actual contributions. It just reflects the results of the valuations. As you can see, there's no request in the upcoming budget request for employer contributions on either side for LRP. Told you I'd keep it short and sweet, so I'm happy to take any questions, but that's all of my prepared comments at this time.
Bo, can you explain to us, or for those that don't understand, how the funding level of these plans continue to go up even though we've stopped giving you money? In fact, you said 2019 was the last time we funded, especially the legislative retirement.
Yeah, the overwhelming driver with regards to the pension side has been the investment returns. Just to give you an idea, last year we were up 15%. Equity markets were up 20%. When you look at like a trailing, 5 to 10 year, it's consistently been well above the assumed rate of return, which is 6.5%. And so, that excess return has been able to add value. And you could see, the recommended employer contributions weren't a ton of money either, right? So, you don't have to overcome as much when you're, only short $400,000 versus, a plan that might be requesting millions of dollars. But on the pension side, the overwhelming has been the investment return. On the insurance side, there's a couple things going on. Number one, specifically with regards to the cash balance plan, the way the current benefit is set for the cash balance plan, you're kind of strategically overfunding that insurance fund. The benefit being kind of accrued in the form of normal cost is very similar to the contributions being received. You're having a lot more turnover within this class of membership, and so 15-year vesting period. So anyone that doesn't make it to 15 years, you're kind of absorbing any of those insurance contributions. One of the reasons you saw a little deterioration is the premiums on that side have gone up quite a bit. I know you all are aware of KEHP. The employer costs went up 13 to 16% depending on the plan. So that's some of the cause. Medicare as well. The Medicare policies have gone up a little bit. So we're having a little bit harder time managing some of the premium inflation. But, prior to here more recently, that's been part of the driving factor as well. You've had positive experience with the premiums.
Bo, you did a good job explaining. I see no questions. Thank you for being here and have a great Thanksgiving.
You too. Thank you.
Next up, David Eager. David, if you don't, KPPA.
All right, you should just have to click in. There you go. My name is David Eager. I'm the Executive Director of the Kentucky Public Pensions Authority, and I appreciate the opportunity to talk today. I think you'll see we have good news. I suspect all three plans systems have good news, and part of it's the hard work that you all did over the years in providing extra funding and elsewhere. Let me explain the actuarial cycle for a minute. I think a lot of you know it, but it's confusing, and I just want to touch base on it. And this is happens every year, but in May and June, our boards approve their assumptions, and there were some assumption changes, particularly the C plan raised their interest rate from 6.25 to 6.5 with regard to the retirement. But that takes place in May and June. In July, the actuary begins to prepare the valuation for the 6/30 valuation, and they'll use those new assumptions. And over on the right, I say, in the first case, it's fiscal 23 when we're doing that. In the second case, when the actuary is doing the valuation, it's fiscal 24. They present their valuation to LRC and to our boards in November. Our board approves those valuations in December. We're still in fiscal 24. The new rates start July 1 of 24, which is fiscal 25. So we're always in our mind kind of getting, which year are we talking about here? So we are going to be talking about the valuation that was done June 30th of 23. Give you some highlights.
Mr. Eager?
Yes, sir.
You have KET here today, and some people at home might not understand when you change those assumed rate of returns.
Yes.
When you raise them, the contribution goes down. And
Correct.
when you lower them, the contribution rate goes up. Can you explain that?
Yeah, we're
The Cliff Notes version?
Sure. We're expecting a certain amount of cash deposits to fund the systems, and when the interest rate goes up, we're assuming we're going to get more from the investments, and therefore we can get less from the employer and employee contributions. They'll offset one another.
So just the opposite if you
Exactly.
lower it.
And that's just as a reminder. Back in 2017, our board approved, and it went into effect in 2019, significant decreases in the interest assumption. It caused a significant increase in the contribution rate, particularly for the K-9 has.
Also explain what it does to your liabilities when you up or down on the assumed rate of return. If you lower your rate of return, assumed rate of return, your liabilities go up.
Go up. And if we raise it, they go down. And you'll see the effect of that in this presentation.
Okay, please proceed.
Sure. Highlights. All 5 of the pension plans had their funded status improved. That's good news. 4 of the 5 insurance funds are fully funded. And we tend to forget about the insurance funds, but there's about $7 billion in the insurance funds now in assets, and 4 of the 5 are fully funded, and the one that's not is over 80% funded. So the insurance, we don't talk about them a lot, and there's not a need to talk about it a lot from a funding standpoint. The additional $695 million we got in appropriations over fiscal 22, 23, and 24, very positive impact. I mean, a $695 million increase in the assets narrowed the unfunded liability. Our investments in KC and state police all outperformed their market benchmarks. Those we had invested in their market basket, we beat it. That might be the wrong term to use, but our returns exceeded it. They exceeded the public fund median return, and they exceeded their assumed rates of return. So it was a very good year from an investment standpoint, particularly relative to other peers or benchmarks. In aggregate, we're positive cash flow, which is, I don't know the percentage, but it's somewhat unique. Pension funds are typically negative cash flow when you take out the investment aspect of it, just in a pure positive cash flow, where we are positive. And House Bill 8 had is having the desired effect. And also a byproduct of House Bill 8, I'm going to show you in a minute, is quite interesting. There it is. We had, I don't know how many, but we had, I know, at least 10 years of declining membership in the K-9 HAS plan, which resulted in an escalation in contribution rates, which resulted in a further decline in participation. This is the downward spiral I've talked about forever. You all passed the House Bill 8. It's set the liability aside, so there's no longer an 83% contribution rate. It's more like 9%. We're only funding the liability is being funded over a period of years that is essentially at a fixed dollar rate. The normal cost is being funded like every other pension fund is a percent of pay, and as a result, employers are not penalized any longer for hiring people. So when they go in prior, if they hired somebody at they have to pay us 83% of their aggregate payroll, or any individual person, and now it's 9%. So they're no longer disincented to have employees. They're actually incented to be able to do that. And there's a pretty dramatic demonstration. The first year is an uptick. It has interesting implications, but on the right as K has, it also had an uptick. Not for exactly the same reasons, but it had an uptick. And so that's what's happened to payroll. So we have more people, and we had across-the-board increases, and we have other salary increases. So the payroll went from $1,355,000 to $1,616,000. We still pay the normal cost on the payroll, so it's going to have an effect, because if people earn more money, their benefits are going to be higher. The need to fund it's going to be higher. That's kind of a side effect of what we were talking about. I'm going to focus today on the June
Dave, let me interrupt you for
Yes.
a second. You talked about House Bill 8 and the effects it's had on participation. There were numerous agencies that moved completely away from KERS. What is the participation now? Do you see most of those quasi units coming back, are starting to put employees back in the system?
You're talking about those that began to outsource over a
Right,
period of time.
that's correct.
I don't have a real, I don't have data on that, but we can try to do our best to get that. I'm not sure we can actually determine that. And my comment about it's encouraged people to hire because the rate is lower is it's an observation, but we don't have a measure on it.
When there's some stipulations in House Bill 8 about those
Moving up.
about those quasi entities coming back into the system.
Yeah. Getting to 60% at one point in time, getting to 80% at another point in
Okay.
time, in order to, if you would like an analysis of that, we'd be happy to give it to you as to what.
Yeah, I'd like to see an analysis and like to see who's not participating also.
Okay. I'm
We
sure
don't mind calling them out.
my staff back here will make a note of that.
Okay, thank you.
Good. So today, focus on the June 30 valuation. We were asked to do a 5-year look back at funding and employer cost. As we do typically, focus on the K-9 HAS. It's the major financial problem. It's the fund where the most state employees participate. To a lesser extent, I'll do K hazardous and state police, and we'll also, at the end, pull some highlights from the CERS. And I say, if you'd like any more detail on any of these plans, let us know. We're happy to do that. So I'm going to pull slides that GRS used to present to our boards. And by the way, I failed to say, Danny White, I believe, is on this call from GRS. Danny, can you acknowledge yourself?
Yes, sir, Mr. Ear. This is Danny White, independent actuary for KPPA and GRS. So if there's any questions or such that Mr. Ear is unable, I will certainly give my best shot.
Yeah.
Well, Danny, welcome to the meeting. We appreciate you zooming in today.
Yeah.
Absolutely.
And I encouraged him if there are things that need to be elaborated on or he had a perspective he wanted to bring up just to speak up. And also I suspect there may be questions that might be better that he answered. So comments on the valuation. Change in the active membership and payroll that we just looked at. K Hazard has had a 28% increase in membership payroll. State Police had a 38%. Employer contributions for the hazardous fund they're no longer tied to the payroll. So we're seeing an increase in the cost, the normal cost of funding the benefit that's accrued each year. On valuation, House Bill 506 reinstated the partial lump sum option. It has essentially limited or no impact on valuation, so it didn't affect the contribution rates or doesn't affect the funded status. House Bill 1 and 604 each provided $240 million of additional appropriations in fiscal 23 and 24. We greatly appreciate that. It makes a pretty good dent in a otherwise difficult unfunded situation. From further comments on evaluation, investment experience, and again, we're looking at K non-HAS primarily, but the K plans are between 7 and 9%, in fact, in excess of 9% in market value, varied by fund. The assumed rate's 5.25% on K non-HAS and state police, 6.25% on K hazardous for retirements, and 6.25% on insurance. And so we essentially exceeded all of those. Fund assets were $158 million more than we expected in the KERS, and 87 more in the state police, and 71 million more in their insurance. The impact of that is more marginal in that it's we use a smoothing over a period of time rather than as the market value. So it had a positive impact, but perhaps not as large as you would expect. Retirement fund liability experience. We had a $445,000 loss, combined primarily due to those salary increases. So we were expecting salary increases of 2%. We got significantly more, and that created this additional unfunded position. The insurance fund liability, we had a $199 million loss in K and the state police there, and it's pre-Medicare premiums were higher than expected, partially offset by Medicare premiums being lower. The caution I would say here is that the insurance liability is much more volatile than the pension liability because of what happens with Medicare rates and reimbursements and so forth. So we've had good years. I mentioned 4 out of the 5 insurance funds are now overfunded, but there could be a turn on that quickly. So we just caution ourselves not to hang our hat too heavily on those. Here's now the numbers for K non-HAS, K-HAS, and the state police, and let me walk you across line by line. Pension fund, 22 val and the 23 val for the K non-HAS. This is be the normal cost, 7.74%, dropping to 6.99. K-HAS going from 30.12 to 23.74, and state police dropping from 85.39 to 65.79. So the combined rates are dropping from 9.6 to 8.4 and so forth across the board. But I call your attention to the 68.1% for state police. That was 147% a few years ago. And you all provided a $215 million additional appropriation, which had a dramatic would be an understatement, dramatic impact. And I'll talk a little bit about the side benefit for that in a minute.
Dave, let me ask you a question on that. On the KERS, non-HAS and hazardous, those contribution rates are not tremendously different. Why would you it seemed like we would continue to do the same rate of contribution to pay down that unfunded liability, especially on the insurance side, because it's probably, like you said, it's more volatile than any of the other things that we fund. Right now we're doing really well. Next year we might not be.
Yeah. Well, the actuary does a calculation to determine what's required to get to the fully funded in 2049.
No, but you can make that decision not to change them, correct?
No, but the legislature can make the decision to fund more than that.
Okay, say that again. The question was about, pull the microphone closer to you. The question, I guess, was, doesn't your board have the ability, when there's a change in contribution rate, that you could choose to leave it where it's at, not lower the rate?
Well, that is a good question. Danny, you want to weigh in on that?
I do. I'm not aware of the board being able to maintain a prior year rate if it's higher. I don't know if the statute permits that. That's something I have to go back and look into. What I do want to comment, I think I know exactly where you're leading into, Mr. Chairman, on the contribution effort and wanting to continue to not let let the foot off the gas pedal. And I think the next slide that Mr. Eager is going to go to will actually show that. While you see the rate themselves go down, we're going to show what this matters in terms of dollar amount.
And let me come back to you on the next slide, Danny. But I would say on this slide, the legislature could say, let's not let it drop from 906 to 857. Let's keep it at 906. Essentially, that's the issue.
That's in the power. Absolutely, that would be in the power of the legislators as you prepare the budget bill.
Dave, we've been requested from Chairman Petrie to give, and it's a good idea, to give us a written opinion on whether or not you all can change those rates. And do you have anything to add to that, Representative Petrie?
If we can simply find out, follow up on that question as you'd indicated, and let us know in writing whether or not they can hold rates steady rather than letting them go down. And I think you've already answered the second question I was going to have, is the statutory change can mandate that, or budget language could either one.
Yes.
Thank you.
Please proceed.
All right. I just to clarify, it was GRS's opinion that the board cannot request something higher, but we can go back and research that just to make sure and have something in writing to you.
Yeah.
Okay. So contributions, they are the main ones K9 has. It's going to drop from $1,036,000,000 to $993 million. It's going to be $43 million less. The unfunded liability.
Mr. Eager, excuse me, if we could go back one slide. So if you look at the KHAS and the state police on the contribution dollars, so while you saw the rates themselves for KHAS go down 6%, in terms of the dollar effort, it's about the same amount of dollars expected to come in. And in the case of state police, where you saw a 21%, or you saw the contribution rate go from 89% to 68%, the actual dollars that are going to continue to go in to fund the system are actually still going to go up by $2. And this is a byproduct of in evaluation, we calculate, all right, what's the dollars we need to come into the system, and then what's the expected payroll. And so because the payroll has increased so much that the rate can go down and still maintain the same dollars. So what you're seeing is a reverse of the experience the state has experienced for the K-non has for many years, or the last decade, because the membership kept going down, the payroll kept going down, and the rate was having to go up. So you're seeing the tailwind or the opposite effect occurring, and especially with the hazardous and state police system. So that's the point of showing the dollar amounts here.
Yeah. Thank you, Danny. Funded status on the three plans drops. The dollar amount drops in each case, most notably in K9 has, from $13.88 billion to $13.10.
Mr. Eager, I want to interrupt you again.
Sure.
Yeah, Chairman Johnson has a question.
Thank you, Mr. Chairman. I just want to stick with the fact that the membership has gone up. Is there any indication that that is going to be a continuing trend? I mean, is it the only reason that the membership went up is because of the spike of money we put in, or?
Yeah. We don't really know the answer to that. I might be able to get the personnel to weigh in a bit on that. One interesting fact would be the number of open positions in the state at one point was 50-some thousand, or 500 and some. It'd be interesting to see if that's narrowed somewhat, like they've begun to fill those positions. But I'll see what perspective I can get from personnel, because other than that, it's anecdotal for us.
And the reason I ask is that I don't want to use a 1 year good piece of good news
Yeah.
become something we think is a trend, and we make assumptions based upon that, and then in a couple of years from now, we find ourselves back in a bad spot again simply because we thought too short term. So I would just, if you look at that, try to use that as a thought. Just a suggestion that let's not use that as benchmark. It's just right now it's just good news.
Excellent point. And we don't have to wait for a year end. We can track on a monthly or quarterly basis what's happening with employment.
Representative Tipton has a question.
Thank you, Mr. Chair. And just for clarification, these valuations, we do valuations in certain years, but those valuations determine what the contribution is in future years. So in this case, the 23 valuation, if I'm reading the footnote correctly, is actually establishing what the required ADEC would be in fiscal year 25 and fiscal year 26.
Right, exactly. Goes back to that cycle we talked about in the beginning.
Mr. Eager, on slide 12, staff tells me that under KERS non-HAS, that 906 million number, we're actually going off the 21 valuation. So
994 is what we're paying.
994 million is what we're paying now.
Yep.
And not the
Yeah.
not the 906.
Yeah, the 906 would be the val for that year, but it's locked in at the higher number for the 2 years,
Okay.
the biennial. Yeah, that's the 2022 val, but the 2021 val would be what was paid in fiscal 23.
Yeah, about 40 million of that decrease in the annual cost that's a benefit of you putting in the additional 480 million. Or it's 240 million in additional appropriations in the last 2 years for so that's the benefit, or the effect of putting in that additional money.
And we want to thank Chairman McDaniel and Chairman Petrie for their leadership on that. That's a great place to park our money. Please proceed.
I think we pretty well covered, have we not here?
Yep. Mm-hmm.
And back to the unfunded, there it is, the reduction, almost $800 million in K-9 HAS. I remind myself that 2 rating agencies improved the rating of two of Kentucky's bonds, and in their write-up, they attributed part of that to more stability in the pension funds and better funding. The pension funds weren't the sole reason, but they were a contributing factor to that. Let me call your attention to the bottom row. We've kind of dealt with the cost at the top. I just broken down maybe more than we need to, but down at the bottom, the liability on the K-9 HAS pensions gone from 16.5 to 16.3, so the liability declined. The assets increased almost by $500 million, so the unfunded liability improved by essentially $800 million, dropping from 18.5, rising from 18.5 to 21.8. 2019, that number was 12.9, and it was the lowest state retirement fund that I'm aware of funded status, and so we're working our way out of it. I remind everybody it's 2049 before we expect to get to 100, and that assumes that all the assumptions are met throughout that period. Insurance, the K-9 HAS insurance rose to 81.7. It's the only one under 100, and it's at 81.7. We'd be delighted if all the pension were at that level. And K-hazardous improved modestly, and K-hazardous insurance is substantially well-funded. I hate to say overfunded because there's a temptation to say, let's do something with that. And I mentioned earlier, that's a volatile number. That number could decline substantially in the near future, in future valuations. State police, this is the great story. The contribution rate dropping from 85.39 to 65.79. I mentioned earlier it was 147% a few years back. And if an agency, an employer, has their contribution rate drop from 147% to 65%, what does it do? It frees them up, frees their budget up to apply those funds elsewhere, to raises for state police, to other things they may need. But they had a tremendous swing in reducing their contributions. And again, thanks to the $215 million. And their liability, which a few years ago was their funded ratio, which a few years ago was 27%, is now going to be 54%. So they've doubled that. Give you a highlight of the county systems. Up top, we're talking about contribution rates. They are through with their phase-in that resulted from when contribution rates were substantially increased in 2019. They're beyond the phase-in period. Now they're coming down. Non-hazardous pension is going to drop from 2334 to 1975. I'm sure employers all around the country look at that number and are pleased. I hope they are. No contribution on the insurance due to its funded status. Hazardous is going from 41 down to 36.79, and a modest decline in a modest rate on their insurance. Funded ratio down at the bottom, increasing from 52 to 56. Insurance is over 100% funded, and hazardous pensions going from 47.6 to 51. So everything is moving toward getting more healthy. Everything is moving toward being fully funded in 2049 if our assumptions are all met. I had some additional.
Representative Tipton, his question.
I apologize, Dave.
Yeah.
We're going to make you work till you retire. But I often get asked by people in the county employment system, well, why am I stuck in the non-hazardous system and not the hazardous system? And, of course, I show them this chart here with the contribution rates, and I have to explain to them that the state, we don't make the determination what system they're in. It is the employer in the county employment retirement system that makes that determination. And I suspect that most of them look at these rates when they're making that determination. Are there any guidelines at all about whether an employee should be classified as non-haz or hazardous, or is that just strictly up to the employer?
Yeah. That's a good question for Erin Surratt, who's sitting behind me. I don't know that you'd want to have her come to the table or not, Representative Tipton.
Yes, let's do. Let's answer his question, please. Here, introduce yourself for the record, and please proceed.
Hi, my name is Erin Surratt. I'm the Executive Director of the Office of Benefits at KPPA. Regarding Representative Tipton's question, it is at the discretion of the employer to petition the board for the hazardous duty coverage. There are some statutory requirements that must be met in order to be considered, the position to be considered hazardous, but it is the requirement of the employer to petition the board.
Thank you.
Please proceed.
Yeah, my standard practice is to throw our benefit system and administration is so complicated that I don't want to misspeak on something I'm not 100%. I had one last something I wanted to show. We talked about in fiscal 22, our average fund was down about 5 to 6%. The average pension fund was down about 9 to 10. So we were fortunate in a declining market. We're structured conservatively, which really helped. This is an article from Pensions and Investments. It's the first 6 months, calendar 6 months of this year, of how pension funds have done. There are 68 of them on this list. Number 4 is Kentucky County Employees, non-hazardous. Number 5 is Kentucky County employees. I'm sorry, the first one's hazardous. The second is non-hazardous. Number 9 is Kentucky employees retirement system. Out of 68, we're 4, 5, and 9. Numbers 3 and 2 are gross of fees. We calculate ours net of fees. So I think I think our investment group really deserves some credit for being able to outperform in one market, and the market turns and we outperform in the other market. So I'm very thankful we have the talent we have, and thanks to you all for passing legislation that allowed us to more appropriately compensate those people. I have additional information in the packet. It's results of a sensitivity study. It's just the kind of the what if. What if we end up earning 1% more than we are assuming we will? And what if we earn 1% less than we assume? I can go into that detail, but I just provided it for background. I wasn't asked to do that. And that's all I have. Oh, I'm sorry. 5 years. I'm looking at Brad up there.
I was trying to follow you. I was trying to figure out where it said
Two
the end.
more pages. This is the 5-year look back, 19 through 23. Funded status on the first. So we're looking at K9 has going from 13.4 up to 21.8, and healthcare from 36 to 81.7, and so forth. You just see across the board increases every year. I'd like to have them be 100%. I'd like to have the incremental gains be greater. From 18.5 to 21.8, it's 2.3. Doesn't sound like a lot. Next year, all other things being equal, it'll probably be 3, and then a year after that, it'll probably be 4 or 4.5. It'll increase steadily in its percentage, just like we keep saying, just like your mortgage. More money going toward principal, less toward interest. And contributions, $1,112,000 in 2019, is fairly steady, and then the drop, because this represents only the normal cost contribution, but projected to be $158 million normal cost, and the liability, unfunded liability write-off is going to be, our cost is going to be $857 million. Projections, again, everything declining, and with reasonable magnitude in most cases. I consider if you look at even go down to the C9 has dropping from 2334 to 1975. That's a big drop from year to year. So, but those are the 5-year projections we were asked to give.
Is that it?
Yeah, unless you want me to go into sensitivity, but you didn't ask for it. I just provided as kind of additional information.
Well, you roughly brought it up about the 1%
Yeah.
increase and 1% decrease. So go ahead and, since you brought it up, cover it.
Okay. It's why do you do a sensitivity study? We get one every year. It projects the future cost and funded status if the experience is different than we're anticipating. If we're anticipating the investments are going to earn 5.25, what if they earn more or less, and what happens? And essentially, if we look at what happens if it's 6.25, it'd be the same thing as we say, let's change the assumption to 6.25. We're going to assume that we're going to earn 6.25, and investment returns is where the big impact is. This is something the board looks at. The board looks at, just go to the top row. The valuation currently says the discount rate is going to be 5.25, and so we look at two bands. One, if you drop it, if the experience is 1 less or 1 more, and if you drop down below, it shows what happens to the liability. The liability today is $16.3 billion. If we assume that we're going to earn another %, they're going to revalue the liability at 14.7 because they're going to say, gee, you're going to earn more in the future than we're expecting you're going to earn, and therefore we discount the amount of liability. and then that shows the change in the funded status. So it would go from 21.8 to 24.2 simply by changing the assumption, which mean, and I don't mean simply by, but that result in that, we're going to say, we're going to assume we're now doing 6.25, and we're going to get 6.25. That's the impact of doing that. So that's what the trustees look at each year, and every time they go through the assumption process, say, do we stay at 5.25? Do we consider something else? And they can say, well, what's the impact of that?
Any questions? Okay, Representative Graham has a question.
I just want to, earlier in doing the interim, there was a discussion, and we had our state retirees come and make proposals in regards to a cost of living increase or the possibility of a 13th retirement check. Have there been any discussions between your office and the discussion between the leadership, the chairmanship? What's the possibility of that, one of those coming into existence in terms of being in the budget or proposal by the General Assembly?
Yeah, I'm not in a position to answer that really. We respond to the requests. What would it cost to do a 1.5% COLA? Raise it 1.5 every year, or raise it 1.5 and keep it there, or do a one-time 1.5, or do a 13th check kind of a thing. We respond periodically to those requests, but I think it's fair to say it's in the legislature's hands as to what.
I understand that, but I'm asking the question to our membership. The possibility of what direction we might be moving in, if there is a direction.
I'll answer that to Representative Graham. I've requested a lot of information from Mr. Eager about different scenarios, and we've had conversations with of course KERS, CERS, and just trying to come up with a plan that we could try to sell to the General Assembly. One of the plans we threw out was a $50 million. How would that flow through the system? What would that look like per employee, per retiree? But nothing is in concrete. But I several of us have had those conversations, and like I said, just trying to find something that.
Well, I think that's a good start, and I hope that we're able to come together and try to figure out some way in which we can help those retirees as well. So I just wanted to put it out there and ask the question,
Sure.
Because that was several meetings ago, and just to see where we are and where we're going with it.
One thing I try to caution everybody, there will not be a COLA. Because we won't do a COLA until it's 100% funded. But what we have tried to do is do that 13th payment. Will that be, I caution on a dollar amount because I don't know what that number would look like. I've seen several scenarios. So we'll continue to work on that. And when I get something I think is favorable, I'll certainly share that with you. Now, I'm not saying that the 13th payment.
I'm just saying,
Yeah.
if you had those
Right.
two,
Right.
but anything is available and
Sure.
able. You and I have been here a long time, and we know how things can work out, particularly at the very end. But I just wanted to bring that up and ask, because I've been asked by many of my constituents, as you might know.
When we say 13th payment, I want to caution you that doesn't mean it'd be identical to their check that they
And I
get.
understand that too,
But
but
it'd be
there's a plan.
in addition.
There's a possibility of a plan.
Yep.
Something in that context. Thank you, Mr.
Thank you for the
Chair.
question.
Uh-huh.
Thank you, Mr. Eager. I think that's all the questions we have for you. You got off easy today. One question I do have, there's a lot of different ones seeking for their retirees not to have to, hazardous duty retirees not paying, the employer not paying any of the employer cost. And some of those costs are very high. You know, I don't know if it's practical to encourage them to do normal cost, which is considerably lower. You know, we've seen that when you talked about the House Bill 8, that those normal costs are considerably lower and entice people to come back into the system. But, you know, when I just want to make sure that funds are flowing back into the system is my concern.
Yeah. Could I suggest we have a conversation on that subject and clarify exactly what we could respond to you with for the
Sure, I
committee?
just wanted to bring that up. I'm getting
Okay.
those questions, and I just wanted to bring that up.
Yep.
All right,
Thank you.
Oh, I don't see my agenda, but I think you're the only one left on as far as the retirement systems. We do have one other presentation. There it is. Bo, when you're ready, identify yourself for the record, and the floor is yours.
Thank you, Mr. Chair. Bo Barnes. I serve as Deputy Executive Secretary and General Counsel for the Teachers Retirement System, TRS. Today, I've also been asked to talk about the 2023 Actuarial Valuation for TRS and also some budget data. I don't know why this is not forwarding. I apologize. I don't know why. There we go. So this first slide is just key actual findings for the June 30th, 2023 valuation. Both the Retirement Annuity Trust, the pension, and the Health Insurance Trust receive full funding. And again, we're very appreciative and thankful for that full funding so we can implement our funding plan. The Retirement Annuity Trust funded ratio stayed just flat at under 60%, which was anticipated, and is anticipated by the actuary in their 30-year projections. And over the next several years, it's going to remain fairly flat. As we've discussed before, this body, that at this stage in the amortization period, we were still at the kind of the end of the first third of the amortization period, the funding status needle does not move a lot, okay? That changes in a few years from now, but at this point, we're not there yet.
Bo, let me interrupt you if you don't mind.
Yes, sir.
Chairman Johnson has a question.
You almost got a full, complete sentence out without being interrupted. Sorry about that. Talking about the funding rate, the ratio being at 58%, it seems like that's where we've been for a while. So I guess maybe I might have a two-part question here, so bear
Yes,
with
sir.
me. Why isn't it changing with the additional funding we put in? I mean, we've put in full funding, but then we've put more on top of that, and yet we're not really seeing a change in the percentage. And I think that's actually my one question.
Okay.
Why
Yes,
is that?
So additional funding was put in to pay off some other unfunded liability for some past benefit improvements, retired teacher sick leave, and some old additional cost of living adjustments. None have been received since 2008, but there are still some payments on those over a 20-year amortized period. So that payment did help. Okay, it did help with the funded, as a plus to the funded ratio, but it's $479 million out of $17 billion in unfunded liabilities. And then that with just the other factors that I'm going to talk about here in a few more slides, it helped, but it doesn't really move the needle that much.
Follow up.
Yes, please proceed.
So just make sure I understand, clarify. A lot of the additional funding we've put in simply went to pay the bills from previous years, 2008, and maybe even before that.
And sick leave liability, yes, unfunded liability.
Are we at the point where if we do find a way to put additional funding in, we're going to actually start seeing this rate drop some, or is it more of the same?
No, with additional funding, certainly that is a huge positive for the funding of the retirement system. You know, getting funding earlier rather than later really helps a lot. And I've got some slides that will kind of show the kind of trajectory we're on, and hopefully that'll help.
Yeah, I probably jumped ahead of your presentation a little bit.
That's
I
all
apologize
right.
for
No,
that.
that's fine.
Thank you, Mr. Chairman.
Thank you. Bo, hopefully you brought your crystal ball today, but can you tell me on the health insurance trust, we're at 71% funded. When do you project we will get to 100% funded?
Okay, so and there's a caveat, and I'll add that after I tell you to answer your question.
I figure there's no crystal balls like mine. It's a little murky.
The actuary is currently projecting 100% funded status for the health insurance trust in 5 years. The caveat is that that depends very heavily on some federal subsidies that we're getting and also prescription drug rebates. If those were worst case scenario, and we actually did a worst case scenario projection, and if we were to do that, if those were to go away, then that would throw everything off, and we would see much lower funded status now, because the cost would go up dramatically from about $204 a month in our Medicare eligible health plan to well over $500 a month. So that would throw the trajectory off greatly. So that's the caveat. We're not hearing that, you know, they're going to do away with the subsidies or the rebates. There's been discussions about it, but no real movement yet. So we anticipate they'll stay there, but no guarantee of anything.
Okay, please proceed.
So there's good news with TRS-4. It is continues to be fully funded. You know, this is for individuals who became members of TRS on or after January 1st, 2022. So it's working as it was intended, and it's working as it was designed. It is working. So great news there. And a reminder, the Commonwealth has no liability for any unfunded liability that it might develop with this new tier plan. We already have 8,000 members in TRS-4. Now, a lot of those are part-time because we've only had really one full school year calendar since January 1st, 2022. But our actuary is projecting that in 5 or 6 years, half of our members will be in TRS-4, for which the Commonwealth has no liability for any unfunded liability that might develop. But of course, what we're seeing now, you know, this is being funded well. It's going to grow well. It's going to stay very well funded. And of course, topped the health insurance fund, top 70% for the very first time ever. Great news. And both the retirement annuity trust and the health insurance trust are on track to be 100% funded as long as within the amortization period. Okay, here's the actual results of the funded status and liabilities, and the top rows reflect the retirement annuity trust, the pension. The bottom rows, the health insurance trust. And I'm going to go straight over to the far right-hand side, but there's certainly questions about any of these numbers. I'd be happy to take those. And this is where you see the funded ratio stayed essentially flat. And again, this is something that was projected by the actuary. It's projected for the next few years as well. It's in their 30-year projections. It was actually last year, the 2022 valuation, it was reported there that they expected this year to be virtually flat compared to last year. This is what we reported to Appropriations and Revenue in September, that they were projecting it be relatively flat. And there's a lot of reasons for this. One of the reasons I will point out is we do the 5-year actuarial smoothing on investment returns, you know. So even though we had a 10.02% return for the last fiscal year, when you do the smoothing of those 5 years, and you have an actuarial value investment return, it's 6.6%, which is of course below our 7.1% assumed rate of return. So that was certainly a driver there. 6.6 is not only below our 7.1 and below the 10.02 we had last year, but it's also below most longer time periods that we have looked at actual market value of returns. But, you know, our actuaries are conservative with our numbers. Looking at the health...
Bo, let me ask you a question, if you
Yes,
don't mind. Under the retirement annuity, your assets looks like they increased by, what, $600 million on the assets, and then but your liabilities went up $1.1 billion. Is that correct?
They went up $600 million. I've got a slide that'll talk about that here shortly.
Okay. Please proceed.
In more details. So health insurance trust, of course, far right, it went from 63.7% last year funded status, 71.3% this year. So great news there, on a really good trajectory. Let's see. Next slide. Negative cash flow. We get asked about this a lot. This is part of their evaluation. So we see that for 2023, negative cash flow was 4.02%. Not much off the previous years, where they're in the high threes, with the exception of 2022, where we had a negative 1.19% cash flow, and that was due to the $479 million appropriation that year.
Bo, on, and you might have that further on in, but 4.4% of negative cash flow, I figure that's about $900 million.
4%. I'm trying to think of that off my head. It's I'd have to get that for you. I'm sorry, sir. I'm just drawing a blank on that.
Okay, well, maybe it'll come to us as we go through here and see some of those figures, but
You are correct. It's 900 million. I apologize.
that's disturbing. It is as we go forward to have that type of, and I know you've told us year in and year out that negative cash flows are healthy, but I don't really see anything healthy about a $900 million negative cash flow.
They are normal, having a negative cash flow with pension plans. Our actuary, and I think other actuaries will say, if you're in the 3 to 4% range, you're in a good spot. That's a manageable spot. That's an okay place to be. It's when it gets to be 5 or 6%. That's when you start to really have concerns by the actuary, and our actuary would certainly alert us if we were starting to get into those realms. But it's manageable for us from an actuarial standpoint and from an investment standpoint too. We're getting cash flow now that we need to be able to invest as we like to do.
I confess I don't know near as much about pensions as your actuaries, but I'm concerned at 4%. So please proceed.
Okay, so this is our actuary every year does a gains loss analysis. And we've been doing this 9 years for now to build in what we call layered amortization over a 20-year period. So every year when we have gains or losses, those gains or losses are recognized over a 20-year period. Of the 9 years, we've had 4 years of gains and 5 years of losses thus far. This year was a loss. And I'll just go over this very quickly. Investment return, of course, with that smoothing at 6.6%, that was a loss on investment return. Salary increases for teachers were higher, than we were projected for this year. So higher salaries mean higher retirement allowances when teachers retire, so that's a loss. Turnover in retirement, they were right on top of this one. So we had more turnovers, refunds of accounts than were anticipated, and we had fewer retirements than were anticipated. Mortality was a slight gain. Our members did not, for the year, live as long as projected, in the assumptions. New entrants, it's not really a loss. It's because the actuary does the annual evaluation on June 30th each year, and they have teachers coming into the classroom that year. And we have teachers coming in, and particularly we have people who are rehired who already have accounts. That represents a liability that has to be acknowledged. So we had, this is reflected here as a addition to the liability. It's just because we haven't accounted for them yet. It's not really technically a loss. Also, this is a lot of things. This is a bucket of things. One of these things is the direct rate smoothing. And what I mean by that is, as a result of the 5-year experience study that our actuary conducted for the 5-year period ending June 30th, 2020, they lowered the assumed rate of investment return from 7.5% to 7.1%. They also, as you recall, changed the mortality table to from a general population table to a table that's more specific to teachers who live longer. And they also adopted a generational mortality table, which assumes that someone who is 25 today is going to live longer than someone who is 65 today. So those really were big, big changes. They are very conservative assumptions now that they have moved to. But as a result of that, we immediately reflected those changes in assumptions in our liabilities and funded status. Immediately recognize those. So what you see now reflects those lowered assumptions. But we were phased in, the actuary recommended phasing in that lowered investment return over a 5-year period. So that started in 2022, and in 2025 we'll have the full phase-in of the additional retirement contributions required by going from 7.5 to 7.1. Bottom line, it was a $600 million loss for this year.
Bo, let me interrupt you there. Under the other, what's the biggest portion of that? And the only reason I asked, I remember back years ago when we were talking about the unfunded liability, and we talked about the causes of it, and there was that other, and it took us a while to get to the bottom of that, but that was payroll growth. What is the other and the biggest portion of other?
It would be, essentially other is the shortfall in money coming in versus the interest growing on the unfunded liability is what we have there. So the direct rate smoothing, which I just talked about, the actuary recommended that because when you go from 7.5 to 7.1, that can have, a big impact on budget requests if you do it all at once. But a lot of pension funds, when they do have reductions in investment rate of returns, and it's an actuarially accepted method of accounting for those reductions in investment returns, and other pension plans use them, is to smooth that in over a period of time, like 5 years. So that means, if we'd phase it all in at once, this other would be much smaller.
One other question, and I'll let you proceed, not interrupt you for a little while. Sick day liability, is that included in any of these figures?
Yes, sir.
Which, and these on the
on
gain
the
and loss?
gains and losses. I do not believe sick leave liability is included in the
Okay.
in the analysis of the gains and losses. These are the big drivers for us you see on this page that we recognize. I don't think that's part of the other, but okay. I can confirm that. But again, $600 million in loss there, and this is where you see the increase in unfunded liability from 16.9 to 17.5 on this slide. We were also asked to provide a 5-year history on contributions to the retirement annuity trust. You see the fiscal year. These are all millions, of course. On the left, you see the fiscal year. Then the second column, the state unfunded liability payment, which is, the largest payment made of all these payments. Next to the unfunded liability payment, state employer fixed, other employers that contribute to TRS, and then members fixed contribution to the retirement system. This is a slide that we've shared with this body before, but again, given the presentation day on valuations, I think it's good to show it again. That top slide, you see that dark blue line, that's the funded ratio. And if you look to the far left, you'll see what our actuary has projected in their 30-year projections, and that is the funded status remains relatively flat for the next few years. And then in about 2031, we start seeing that funded status start to get better more sharply. And that'll continue until we reach 100% funded status in the outer years. And then also you can see in the bottom line, the dark green line, when we get to 100% funded, that the contributions made by the Commonwealth drop dramatically. This is the 5-year history on contributions to the health insurance trust. Again, we have the fiscal year, we have contributions made by the Commonwealth to the Health Insurance Trust, other employers, and members and retirees. Largely self-explanatory. Okay, and we're asked to talk about our 2024-2026 budget request. You see first the actual for 2024 on the left, pension, $650 million, state share responsibility portion, $77.7 million. The request for fiscal year 25, $769,840,000 for pension, $76,900,000 for medical. One of the board members emailed me just before the meeting today, and they wanted me to, and I hope I understand their question correctly, but explain how we do some of this budgeting. And specifically, we do something we call it over-under on budget requests, where we kind of do a reconciliation. And we do that specifically for the fixed statutory rate we receive through the SEEK funding formula, and we also do it for the state share responsibility portion. And the reason we have to do a kind of look back and a reconciliation is because we don't know when we make our budget requests for sure what the salaries are going to be, statewide payroll for the next 2 years is going to be. We do a projection. You're never going to get it 100% accurate. So some years it's salaries less, sometimes payroll is less, and sometimes payroll is more. And then we build that into our budget requests. We'll reduce or add dollars accordingly. And same thing with health insurance. We don't know certainly what the next 2 years of premiums are going to be, particularly the second year. So that's also a projection. If it's more or less, then we adjust our budget request accordingly. And I hope I got that board member's question correct. Fiscal year 26, for the pension, $953 million. 31,000, and for medical, 84,200. I'll also add, this is our state budget request to, that we send down to LRC and to the executive branch. In addition to this, and this is through the KDE budget, there is that SEEK funding formula request. So in 2024, for example, there was an additional $448 million received through the SEEK formula, for a total of $1.12 billion received in total by TRS. In 2025, there was a request of $460 million for the SEEK formula, for a total of $1.347 billion received by TRS. And for fiscal year 26, $470 million is requested through the SEEK formula, for a total of $1.461 billion received by TRS.
Bo, can I interrupt you there for a
Yes,
second?
sir.
Of course, most of us remember 2016 when we first started paying the unfunded liability, when we paid $500 million in each year, close to $500 million in 2016, in that budget 16 and 17.
Yes, sir.
So in 10 years, it's goes from $500 million to it almost doubled our payments, our unfunded payments on the unfunded liability, basically doubled. And my big concern is by the projections show by 2032, that ask from TRS will be over $2 billion in each fiscal year.
Yes, it will get to that, and it'll grow more modestly in some of the out years, and in the final few years of that amortization period, it gets a little more flat. But yes, you are going to see some growth up to about $2 billion, a little over $2 billion, and then you'll start to see it stabilize a little bit more.
Well, that's a heavy lift,
Yes, sir.
and you don't really test us on that commitment to fully fund it. So anyway, I'm just speaking for myself, but that is a heavy lift.
Let's see. The next slide, this too is fairly self-explanatory. It simply offers some greater detail about budget requests for the current and for the next 2 fiscal years. So that concludes my presentation. I would be happy to take any questions if there are about my presentation or anything else about TRS.
Senator Mills.
One short question.
Yes, sir.
Can you just give some more commentary on the budget request? What is built in on the increase from 25 to 26, from the 769 to 953?
Those are based, I believe that would be...
As far as the increase?
Yes, sir. A lot of that is going to be on the unfunded liability payments that the actuary has projected. You'll see in the second column here, I don't know. I don't have that here. I don't have those years here, unfortunately. But I think a lot of that is going to be driven by just unfunded liability payments. In fact, almost all of it.
Back to, you all chose not to phase in, I think, on those losses and just to do the smoothing. What would the difference been in the contribution rates had you decided to phase it in rather than to just smooth it?
Oh, on
The losses you had over the last couple of years.
Well, okay. So we're talking about this slide, the gains losses.
Right.
No, those are layered 20-year amortization. So it's over 20-year periods, and they can somewhat cancel each other out, from year to year, because we've had 9 years of this, 4 gains, 5 losses. But I don't have, if we just paid this all at once instead of doing it over a 20-year period, I don't have that. I could ask our actuary to provide that if you'd like that, sir.
Yes, please.
Okay.
One final question. On sick days, we paid off last budget cycle, we paid off the sick day liability for current retired teachers. And we've talked about a number for current teachers, the sick day liability. That number is what, 500 and some million? Is that?
My recollection is $563 million.
563 million. So.
And that's based on the 2022 valuation too. So we would have a new number, if that's needed.
Of course, that's my recommendation to lobby to pay that off, because I think that would be with surplus funds. I can't think of any better way to use it than to pay off our unfunded liabilities. And I guess, I've asked you this question before about that liability. Do you know, how do you determine that? Because you really don't know the sick day liability. From my understanding from you, you don't know what sick day liability is until a teacher retires.
Not on an individual basis, but on a group basis of the entire membership population. They have a very good idea about what that sick leave liability is based on what we've seen, the history that we have, what they know teachers are getting in sick leave. And if that $563 million were appropriated, or whatever the number would be based on the 2023 valuation, there would be no contribution by the Commonwealth towards sick leave. But there would still be the 20-year layered smoothing I talked about. Even with a 100% funded pension fund or anything, you're always going to be looking every year and see what was your experience versus what the actuaries expected. And you're always kind of making those little tweaks every year so you make sure you stay 100% funded. But that would be the only thing left, and that would address any issue going forward in the future. But they have a real good idea about what sick leave liability is.
But it's an estimate. It's not an accurate figure.
Yes, it's a projection.
Okay. Thank you. Any further questions? Seeing none, thank you, Bo.
Thank you.
Appreciate you being here. Next up, Representative Grossberg. Sorry, you get the honor of being last today.
I might need some technical assistance here.
Okay.
Sorry, I'm trying to close out.
That's okay. Take your time.
Close somebody else's. There we go.
Representative Grossberg, the floor is yours. Introduce your guest and for the record, identify yourself for the record, and please proceed.
Thank you, Mr. Chairman. Representative Daniel Grossberg, 30th District out of Louisville, Jefferson County. And with me is Ms. Adele Singer. She is a retired Jefferson County Public Schools teacher. So once again, thank you. I'm honored to be here today. With me as guests in the audience are Mindy Haas, the Executive Director of the Federation of the Bluegrass, Sarah Wagner, the President and CEO of the Louisville Jewish Federation, Larry Singer, who's Adele's husband, also the most vicious tax man on earth, as in a tax preparator, not IRS. If you guys ever need help, he makes them weep and cry. And then a surprise guest, my wife, Erica Grossberg, who shocked me. She did not tell me she had any intention of coming here, but this bill does impact people like her. I also wanted to give a specific thank you to Matt Golden and Justin Sadel. They are each the directors of Jewish Community Relations for Louisville and Lexington, respectively. So the reason we are here to discuss this bill is that we live in a state where if you take off for religious holidays that are not fixed into the school calendar, you cannot be punished, you can't be docked pay or penalized, but it can count against your retirement. So if, for the example that Ms. Singer is going to give in a few minutes, if she were to take off for Rosh Hashanah and Yom Kippur and for Passover as she did, she can make up those days of work elsewhere in the calendar, teaching summer school, proctoring ACTs and SATs, doing orientation days, teacher training days. Those days are paid days, but they do not count towards retirement. And if you work a full career, taking 4 or 5 days off, sometimes more if you're more observant, that can count towards you missing even a full year, sometimes 2 years of retirement eligibility. I'm grateful to live in the Commonwealth of Kentucky, where religious freedom is held to such high regard. I know that Kentucky has the Religious Freedom Restoration Act, which prohibits the concerns that I expressed do not exist, that you cannot punish a teacher just as you can't punish any other public employee for the free exercise. But we have that gap right now. Ms. Singer is going to read into the record a brief letter that she wrote for you guys. But before I have her tell her story, I'm going to tell you the story of a teacher who couldn't be here today because she's still an active teacher. She is Jewish, and in her nearly 20-year career, whenever she's needed to take off for a holiday, she's been asked to, first of all, prove that she is Jewish, and then prove that such a holiday exists. I can't tell you all the level of offense it is to ask someone to prove they are Jewish and then to prove that there's an actual holiday. So with that, I'm going to have Ms. Singer read her letter, but I also wanted to give particular thanks to Representative Tipton. When I first drafted this bill, I brought it to him. I was suggested bring it to the chair of education. He said, I like the idea, but slow down there, cowboy. We got a lot of work to do. I need to run this by the teachers to make sure they're on board, and they are. The administrators to make sure they're on board, they are. Run it by the actuaries at the Kentucky Teacher Retirement System, where they saw no objection. They said it would have a minimal impact, and a few other stakeholders. And ultimately, last year, he signed on as a co-sponsor, for which I'm very grateful, but told me there was no chance in the short session we were going to get to it, but he would help me and make sure it got in front of the relevant people and the relevant committee during the interim, and that's why we are here. So a special thank you on the record to Representative Tipton. And with that, before I give a final request and answer any questions, I will ask Ms. Singer to read her letter into the record.
Is this on? It's on, yes. Okay. Dear esteemed members of the Kentucky General Assembly, in August 1990, I started working for Jefferson County Public Schools. When the Jewish holidays approached, I asked my principal what to do about taking off so that I could observe. Since I only had 3 personal days a year, and there were 13 days of holidays, I was told to call in sick. It didn't seem right to me, but I did what I was told. Teachers are told you listen to your principal. You don't question them. After doing this for a few years, I wrote to the ADL, the Anti-Defamation League, to ask what to do so I could take off those days without lying. I was told that I could take off with unpaid days once I had used my 3 yearly personal days, which is what I did. Over the 18 years I worked for Jefferson County Public Schools, I either lost sick days or unpaid days that cost me an entire year of service towards my retirement. If I had had the opportunity to make up these days elsewhere at JCPS, I would have gladly done so. However, this was not available. I am proud and grateful to be a citizen of the Commonwealth of Kentucky, where religious freedom is so highly valued. I hope that this august body will pass this bill so that future teachers of minority religions will be able to celebrate their religions openly and fairly. Thank you for your time and consideration. Adele Singer.
Now, this bill was inspired by Ms. Singer, and when it passes this upcoming session, I'm going to have it stylized as Adele's law, but be clear that this does not only impact Jewish teachers. There are other minority religions, Buddhists, Hindus, Muslims, who may be impacted by the current school calendar. I also think it's worth noting in her letter that someone who is highly observant would take up to 13 days off, and my bill only requests that teachers be allowed to make up to 10 days towards retirement because, as she stated, you have 3 days that you can take off for personal leave for whatever reason that you want. But just think about the status quo for a second, that a teacher is told you either need to fake illness or not observe your own religion. Those aren't the Kentucky values that we all share. I think it's also worth noting that in the last 6 weeks, many of my colleagues, including people in this room, have come up to me amid the historic rise in anti-Semitism and asked me, what can we do to fight back? What can we do to show our support for the Jewish people? This is an example. This is not a token bill, nor will it impact only teachers. This is real support. This is a reassurance, a commitment, and a validation to the Jewish people that we are welcome, wanted, and valued in Kentucky. With that, Mr. Chairman, I am available for any questions.
Okay. Representative Graham has a question.
Yes, thank you, Mr. Chair. I want to follow up with when you were told that you could take off, but you would not. You would have to pay those times back. Mm-hmm. And you talked about some of the things that you could do to make up. Usually, and I'm a former educator. Okay. I don't want to say former because educators think they can always be educators.
Yeah.
But when I worked, and when I took a leave of absence coming here, mm-hmm. I was able to do other work. We were on a different system. We were on a year-round system. Mm-hmm. So we would go nine weeks at school, and then we would have 3 weeks out. And then one of those weeks would be you could teach kids who were behind in that 9-week period, and then you would have 2 weeks of which you would have vacation time. And some teachers chose not to do it. Mm-hmm. My point being was that you could make up those days by coming and teaching within that period of time. Were there summer schools, for example, an example of where you could possibly make up those days that you missed? I think you said, was it 12 days that you? How many?
10 days.
10 days?
Yeah, that would be accurate post-passage of this bill, but districts that don't have a year-round system will allow teachers to work.
I'm just saying you're able to try to do other things like they.
Correct,
most
yes.
districts have summer school.
Yes.
So you could possibly work that out through your superintendent and your principal.
With passage of the bill, correct. But currently in Jefferson County, you can get those days as paid days, but they do not credit towards retirement. The only days that credit towards retirement are the regular calendar school days. So whether you're teaching summer school or ACT and SAT, or you do in service for the freshman orientation or new teacher orientation, those are qualified days of pay, but they are not calendar days that count towards the retirement, so they don't accrue.
So what you're trying to do is make any time of a teacher is teaching, regardless whether it's the calendar days or whether it's the days in which they are working.
90%, yes. So you can't bank extra days and say, I'm going to work summer school so that I can skip ahead and retire early. But you are correct in that if you were to need those days for the religious observance, you can make it up.
Need remediation, and so
Yes.
there are teachers who come in the summer who help get those kids back or get them up to where they need
Correct,
to be.
and that would count towards your retirement now. You've always been paid for that, but now it will also count for your retirement in those districts that have left that donut hole.
Is Bo still here?
Don't see.
Okay, all right. That's something that we need to see if that is the case.
Can I add something?
Sure.
The other thing is I taught, they had extra lessons for kids who were falling behind after school 2 days a week. And I did, volunteer. I said I would teach those. The problem is you get $25 an hour, whereas my base pay was, for teaching it during the calendar year was over $70 an hour. So they give you a separate check. It has nothing to do with retirement. And I was just, because I was losing so much money at the time, I was a single mom, I took any job that they could give me at $20 an hour, 25, an extra in service, an extra going through, I was a special ed teacher, going through IEPs to make sure they were up to date, anything I could do to get, to make up, because 10 days is a lot. That's 2 weeks out of a school year. That's 36 weeks. That's a lot of time. So I would take that, but the pay was not the same. And like Daniel said, it did not go towards my retirement. It was just, an extra check that I got. They give you a separate check, and it has nothing to do with retirement.
Yeah, turn your
The
microphone on.
discussion, let me suggest that the discussion, and I have no problems with the bill, but I would hope that the discussion would be, have you discussed this with the teacher's retirement as well, and what the impact that would be? Have you followed up with those discussions?
Yes, we have, and Representative Tipton double-checked on it, and we both got the same answer with a written report that there would be minimal impact on the retirement system. Because once again, this is not for someone to bank in advance extra days to get an early retirement. It's for them to be allowed to use those other days that you have done, that Ms. Singer, that my wife has done, and count those towards retirement. It's specifically to make sure that someone who is observant and therefore doesn't get 180 of the 185 required days per year on the school calendar, that they don't retire a year shy of what they've done or be forced in the classroom a year longer than they are comfortable being. I mean, we all know that there's a major teacher shortage, but the last thing we want is people in the classroom who don't want to be there. I also think, and I have no statistics to back this up, but this is intuition, that this would be an effective recruiting tool to get greater religious diversity among teachers. If we tell teachers, you can still practice Judaism, Buddhism, Hinduism, and be a teacher. You can still get your days off, and all that we ask is you make up the days elsewhere. And I can say that it's unique to teaching because every other department, whether it's being a police officer, a fire officer, working in transportation, working in parks, working for education at the state, there are so many more days in the calendar that it's not difficult to miss a few days and make them up. And in fact, Jewish people are notorious for wanting to work on Christmas and Easter because it's often time and a half or double pay. But that's not an option in the school system. What is the option are occasional weekends and the summer weeks and sometimes the winter weeks. And with a year-round calendar like you were fortunate enough to have, there are even more opportunities. But right now there's that deficit of opportunity. And there's an inconsistency in our largest district that there are some principals who overtly tell teachers, call in sick, I won't ask anything. And then there are principals, as the ones I spoke of earlier, who will tell someone, I don't believe you're Jewish. You need to prove you're Jewish, and you need to prove to me that there's a holiday, which is why Section 1C here says that it's just based upon the teacher affirming that they have a holiday and that there's not going to be the challenge. But in order to be reasonable, we set it at 10 days. I think beyond 10 days is more than a reasonable accommodation. But that was an excellent question. Of course, leave it to the one teacher in the chamber to ask me that question. But I'm happy to answer any other questions.
Well, are they, I mean, I guess what I'm saying is that it may be that it's a school principal who is doing this rather than following up with the policies that the district in itself has.
Excellent
That's
point.
the only concern that I have.
But I've discussed it with JCPS, who is on board. I wouldn't say that they're endorsing it, but they are on board, and they have confirmed that the district-wide policy per the contract is that there are these many calendar days, 185 of these days, and you may not miss more than 5 of these 185 days, no matter what else you do elsewhere. And they do not seem compelled to change that contract. So I think it's incumbent upon us to say that their contract has to comport with the values of the Commonwealth, which is religious freedom, religious inclusion. And as I said, to me, this is in direct conflict of the Religious Freedom Restoration Act. But I'm not going to start encouraging teachers to sue their own school district. And my understanding is there are other districts that are impacted as well. And it is my understanding that JCPS would not object to these changes because it is so narrowly focused and well-defined as to when you get to miss and how you make it up. It's not any time UK is having a basketball game you get to call on a holiday and make it up.
So you're saying that that you've been working with them and they have no concerns. I mean, I'm just
that is correct. And Representative Tipton spoke to the forgive me, what is it called? The School Board Administrators Association of School Board Administrators, or
Mr. Chair, I'm responding to a question from Representative Grossberg.
I'm sorry, I was in a sidebar conversation. So, Representative Tipton.
I've talked to so many people I can't remember right now, Representative Grossberg. But you've got the Kentucky Association of School Administrators, Kentucky Association of School Superintendents, and if I could make a point while I've got the floor, I think the key thing here is in 1B in pre-existing language, or it mentions that the teachers, non-university members, and the issue is what qualifies as a full year of service credit in relation to the contract that the teacher has with the school system. These contracts range from some of them 185 days. I know some of them, I think Fayette goes up to 189 days. So the issue is you cannot miss no more than 5 days within the term of that contract, that school calendar year. What you're proposing here will allow the teacher to make up those days if they observe days for religious purposes outside the traditional school calendar year.
Thank you for that improvement summary on what I'm trying to say. Thank you, sir.
Auditor Harmon has a question.
Thank you all. I appreciate you all bringing this forward. Of course, not a legislator anymore, so I can't really help in that aspect, but do have a quick question. And as I read this, it seems like this bill is going forward. Sadly, I don't think it addresses the items that have occurred over the last couple of years. Is that correct or incorrect? I just did a quick read of the bill.
That is correct. For political expediency and for passage, we can discuss in the future doing something for those who have already lost credit and those who are already in the retirement system, like Ms. Singer. But my primary objective was for those currently in the system going forward to make sure that they are not further penalized for their religious observance. But very astute observation from an auditor.
Thank you for bringing it. Thank you, Mr. Chairman.
One final question. We have 10 sick days every year. What if we redid the definition of a sick day that you could use it for sick or for a religious reason?
Mr. Chairman, that's exactly what my wife told me to ask, and apparently I messed up by not doing that. But in my conversations with other members of the General Assembly, it sounds like that is a much larger lift to convert from sick days to PTO, personal time off. So I would leave that to more experienced people to determine if that's possible. This I know is possible. I know there's enough support if we can have regular session hearings on it. I do firmly believe this will pass, and then we can have the wider discussion as to whether or not we want to define sick days as only medical or if we want to make them PTO. But that is a broader conversation that may have the support but doesn't have the unanimous support that I have experienced thus far with this bill. And if I may add one more thing, since I had to bring my wife into the conversation, I know there's several senators in the room. You've never heard the true joke that she is my favorite person on earth, and as she regularly reminds me, I'm her third favorite state representative.
With that said, thank you for being here.